Welcome to the deep dive. Today we're cutting straight to what is maybe the most important financial story a company tells.
The income statement.
Exactly, the P&L. And our mission is pretty simple, right?
Yeah.
We want to answer that one crucial question.
How profitable was this business over, say, the last quarter or the last year?
And we're going to do that by getting past all the jargon.
For sure. And to really understand it, you need an analogy. Think of the income statement as a kind of financial funnel.
A funnel.
Money gets poured in at the very top. That's your revenue.
And then it gets filtered.
Exactly. Gravity pulls it through a series of filters that capture all the costs, and only the real final profit drips out at the bottom.
So let's start at that wide open top, the revenue.
Yeah.
Or sales. This is just the raw cash value of everything sold, right?
But here's the trap, and it's a big one. The sources we looked at are all very clear on this.
Revenue is vanity.
It's total vanity. The size of that number can mean absolutely nothing. I mean, think about that classic example.
The $10 bills?
You can have $1 billion in revenue, which sounds incredible. But if you got it by selling $10 bills for $9 each.
You've just manufactured a massive loss. So you can't judge a business on revenue alone?
Never. So that brings us to the very first filter in our funnel.
What's the first thing we have to subtract to find out if the product itself is even worth making?
That's your cost of goods sold. COGS for short.
Okay, what's in COGS?
This is only the direct cost to make the thing you sold. Raw materials, the labor on the factory floor, anything that scales directly with production.
And when you subtract that from revenue, you get...
Gross profit. And from that, you get the really important metric, gross margin.
Which is just gross profit divided by revenue. So what does that number actually tell you?
It tells you if the basic business model makes sense. It's fundamental. Think about the contrast. Like, a software company might have a 90% gross margin.
Because it costs almost nothing to sell one more copy of the software.
Exactly. But then a grocery store, they might have a gross margin closer to, what, 3%?
So a high margin means it's easier to scale, and a low margin means you just need huge volume to even survive.
Precisely.
Okay, so once we know the product can make money, we hit that next big filter, the bloated middle.
The bloated middle. Operating expenses or OPEX?
This is the cost to just run the business, right?
Yeah.
Rent, marketing, R&D, my salary, your salary.
All of it. And this is where so many companies just hemorrhage profit. They could have a fantastic gross margin, but then management gets carried away.
Fancy offices, private jets.
You've seen it. Layers of redundant managers, huge marketing budgets. It just destroys the profit that the core product created.
So after we subtract all that OPEX, what do we have left?
Now we get to one of the most important numbers in finance, operating income. You'll often hear it called EBIT.
Earnings before interest and taxes. Why is this number so important? I know the sources mentioned Warren Buffett is a huge fan of it.
He is, because it's clean. It shows you the profit from the actual business operations. It ignores how the company is financed or what its tax situation is.
So it strips out the noise.
All the noise. You can compare the operational muscle of a company with tons of debt to a tech company with zero debt on, an apples-to-apples basis. It's pure managerial efficiency.
Okay, so we're almost at the bottom of the funnel. Just two more little filters.
The final two. Payments to the bank, which is interest, and payments to the government, taxes.
And the very last little drip that comes out is?
Net income. That's the bottom line, the true final profit for the shareholders. This is the number that gives you earnings per share, or EPS.
But the sources point out there's a huge conflict here. Companies are, they're incentivized to play games with this number to hit their targets.
Oh, absolutely. This is the most managed, most optimized, and maybe the most vulnerable number on the whole statement.
What did that look like?
It can be aggressive accounting, like recognizing revenue way too early or pushing costs into the future. Or, you see this all the time now, using adjusted earnings that just happen to exclude a bunch of real costs.
So to wrap this all up for you, we've gone on this journey from the vanity of revenue down through the crucial filters, landing on that essential number, operating income.
And then finally down to that last, often manipulated drip of net income.
The key is that understanding this funnel means you have to look past the headline number. You have to see where the profits are actually being created.
Or where they're being destroyed. Which leaves you with a really important question to think about. When you're looking at a company's P&L, is it more dangerous for them to have a really low gross margin or to have runaway operating expenses? And why? Understanding that difference tells you everything about where the real risk is. That's your next deep dive.
Okay, we are jumping straight into what might be the single most important document for uh, really assessing a company's immediate health, the balance sheet.
It really is. Our mission today is to get you comfortable with it because it's so different from the income statement. Think of it like a snapshot.
A snapshot, right. So the income statement is the whole movie of the year.
And the balance sheet is just one photo taken at 11:59 p.m. on December 31st. It tells you what a company has and owes at that exact moment.
And it all hangs on one simple but really brilliant rule, the golden rule of accounting.
Assets, liabilities, plus shareholders' equity. That has to balance, always.
So let's start with the first part of that, assets.
Right, what the company owns. And the key for you to remember is that they're ordered by liquidity.
Liquidity meaning how fast you can turn it into cold, hard cash.
Exactly. So you start with current assets. Cash itself, inventory, accounts receivable.
The easy stuff.
Yeah.
But then you move down the list to non-current assets,
Yeah.
the big things.
The heavy hitters, factories, real estate, patents. But this is where we find a really fascinating one. Goodwill.
Okay, goodwill. This one always seems a bit strange. You're saying it's created when a company basically overpays for another one.
That's a perfect way to put it, yes. If a company's assets are worth $10 million, but you pay $15 million for it.
That extra $5 million just shows up on my balance sheet as this asset called goodwill. That sounds almost like a fake asset.
Well, many analysts would agree with you. It's often the first thing they subtract to find a company's true value. A huge goodwill number can be a red flag.
I see. So now let's flip to the other side of that equation. Liabilities. What the company owes.
And these are ordered by urgency?
Urgency, that makes perfect sense. You've got your current liability.
Right, all the bills due in the next 12 months, money you owe to suppliers, short-term loans.
And then the long-term liabilities. Those are the massive debts, right? The ones due in 5, 10, even 20 years.
Precisely. And after you account for all the assets and all the liabilities, what's left over is shareholders' equity.
Which is also called the book value.
Yep. It's what would be left for the owners if, hypothetically, the company sold everything and paid off every single debt.
And a huge part of that is something called retained earnings. Help us out. What is that conceptually?
Just think of it as the company's lifetime savings account. It's the grand total of all the profit the company has ever made and decided to keep and reinvest instead of paying it out to shareholders.
Okay, so this is where it all connects. You can have a fantastic movie, a great income statement showing tons of growth.
But the snapshot, the balance sheet, can show you're actually about to hit a wall. The income statement is about growth. The balance sheet is about survival.
So you could be making billions in profit, but if you have a huge loan due tomorrow...
Exactly. If you have a $1 billion loan due next week and only $100 million in cash, your balance sheet reveals you're insolvent. Right now, it's about surviving a shock.
And that leads right into the negative equity trap, where liabilities are actually bigger than assets. It sounds like complete financial ruin. Shareholders get nothing.
And often it is ruin. But here's a wild strategic twist. Some huge, stable companies, think McDonald's, think Starbucks, sometimes run with negative equity on purpose.
Wait, what? That sounds insane. Why on earth would they want to look that fragile on paper?
Because they're so confident in their cash flow, the movie, that they borrow money very cheaply, which is a liability, to aggressively buy back their own stock.
And buying back stock reduces the total equity value, so they're leveraging their stability to manipulate their own value.
You've got it. It's a high-stakes game, but for them, it can work.
So the core takeaway for you listening should be what?
That understanding the balance sheet is understanding a company's real, immediate financial health. It's the ultimate measure of its ability to withstand a storm. It's survival.
So if the balance sheet is a snapshot of survival, here's a final thought for you to explore. What current major companies rely almost entirely on their ability to manage that cash flow moment to moment, making their financial photo the riskiest, yet maybe the most fascinating form of financial art?
Today, we are doing a deep dive into the cash flow statement. It's really the ultimate financial shortcut.
It is.
Our whole mission here is to follow the actual dollars, because in finance, you always hear this one mantra. Profit is an opinion, but cash is a fact.
And that's everything, isn't it? That tension. People always ask, why is profit just an opinion?
All right.
It's because of something called accrual accounting. A company can sell $1 million of software, right, on 90-day credit.
Okay.
Well, that revenue, it hits their income statement immediately, makes them look rich on paper. But for 3 whole months, Their bank account is completely empty.
So the cash flow statement, the CFS, that's what cuts through the noise.
Exactly. It's the financial lie detector. It strips away all that timing, all that, accounting magic, and just shows you the money.
Okay, so we need to follow that cash trail. There are 3 crucial sections. Let's think of it as company's engine, its future, and its bank.
Good way to put it.
Let's start with the engine. Cash from operations, or CFO. This is the cash that comes purely from the core business.
Selling the actual product or service.
Exactly.
And what's really fascinating here is the golden rule. For any stable, mature business, this number, it absolutely must be positive.
So what if it's not? What if a company reports this huge net income, looks really profitable, but its CFO is negative?
That is a massive red flag. It means they're burning cash.
But hold on, couldn't a negative CFO just mean a company's growing really fast? Like a retailer building up a ton of inventory before the holidays. Where's the line between growth and a real problem?
That's a critical distinction. And yes, a temporary inventory build can cause a short-term negative CFO. But if you see it happening year after year, that points to a structural failure.
Meaning what, exactly?
Meaning they're either selling stuff they can't collect payment for, or their costs are just genuinely out of control. It's a serious issue, no matter what the income statement says.
Okay, so once we know the engine is working, we look at where the company is investing in its future. That's section 2, right? Cash from investing.
Cash from investing, or CFI. And this is usually a negative number, which is a good thing.
Because it means they're spending money to grow.
Right. They're buying new factories, new tech, building out infrastructure. And within CFI, we look for one specific thing: capital expenditures. CapEx.
That's the money just to maintain the business, keep the lights on.
Precisely. And when you take your engine, the CFO, and you subtract that maintenance cost, the CapEx, you get the holy grail metric.
Free cash flow, FCF.
You got it, FCF. And this is the cash that's truly available to the owners after running and maintaining the whole operation. It's what you use to pay dividends, buy back stock, reduce debt.
So it's the real measure of a company's value, not its paper profit.
100%. It's the primary input for almost every sophisticated valuation model.
Okay, finally we have the third section, what we're calling the bank, cash from financing, or CFF.
And this section is pretty simple. It tracks all the money flowing in from outside sources, like issuing stock or borrowing from a bank, and all the money flowing out to shareholders, like dividends.
This is where you can quickly see if a company is self-sufficient.
Or if it's on life support. And this brings us to the perfect real-world example, the Amazon story.
Right. For almost 20 years, Amazon reported basically zero profit, zero net income. And Wall Street just hammered them for it.
Oh, they hated it. But the smart money, they weren't even looking at the income statement.
They were looking straight at the cash flow statement.
Straight at the CFS. And they saw this massive, growing operating cash flow. The engine was a monster.
They just saw that Amazon was taking every single dollar from that engine.
Every penny.
And plowing it right back into investing cash flow, building warehouses, data centers, logistics.
They weren't losing money. They were just reinvesting everything internally to scale up and become this global behemoth. The CFS told you that story years before the income statement ever did.
So understanding this one statement fundamentally changes how you see a company's health. You start to ignore the accounting opinions.
And you just follow the dollars, the real cash that actually funds growth.
Which leaves an important question for you to explore. Think about this concept of profitless prosperity. How do today's startups use that financing section, all that venture capital funding, to survive for years with negative operating cash flow? And at what point does that external financial music finally stop?
All right, let's dive right in. We're going to unpack the difference between a company that looks profitable and one that's actually, healthy.
Exactly. And our whole mission here is to find the ratios that really separate long-term stability from, just being on life support.
And it seems to boil down to one central idea, right?
It does. It's that a business failure is almost never caused by a lack of profit. It's a lack of cash.
So it's that old saying, house rich and cash poor, but for a corporation.
That's the perfect way to put it.
Okay, so we're talking about two different timelines. There's liquidity, which is, can you pay the bills due today?
Mm-hmm. And then there's solvency. That's the long game. Can you pay off that giant loan eventually?
And I guess if you don't have the liquidity, the solvency doesn't even matter.
You won't be around long enough to worry about it. Cash is the immediate killer.
So let's start there with that emergency fund. The first check is the current ratio, which is current assets divided by.
by current liabilities. And, the textbook number you're looking for is something like 1.5, maybe 2.0.
Meaning you have $2 ready to go for every $1 you owe soon.
Right. But here's the interesting part. If you see a ratio of, say, 8 or 10, that should also be a red flag.
Wait, so having too much cash is a bad thing? How does that work?
It signals incompetence. It means management is just hoarding cash, not investing it, not growing the business. It's lazy.
An inefficient balance sheet.
Precisely.
Yeah.
Now, if we want the brutal truth of their immediate situation, we look at the quick ratio.
The acid test.
The acid test, yeah.
So why is it so brutal? The formula is pretty similar, but you pull out inventory.
We pull out inventory because it isn't quick cash. I mean, think about it. You can't count on selling 10,000 winter coats in the middle of July to pay a bill that's due tomorrow.
Okay, so it's what you have if you can't have a fire sale. It's your true immediate cash power.
Exactly. It separates what's real from what you hope you can sell.
That makes sense. So that settles the short-term panic. But keeping the lights on is only half the battle. Now we need to ask, who really owns this company in the long run?
That's the solvency question. Is it the shareholders or is it the bank? And for that, we look at the debt-to-equity ratio.
Total liabilities divided by shareholder equity.
Right. And what's fascinating is how this works like a financial turbocharger.
You mean a company with a really low ratio, say under 0.1, is super conservative, maybe a bit boring?
Yeah, very stable. But a company with a high ratio, let's say over 2.0, is highly levered.
So in good times, profits are just massively amplified.
Massively. But if things go south, even a little bit, that leverage works in reverse and can cause instant bankruptcy. It's a high-wire act.
And to really gauge that danger, we need to know if they can even afford the interest payments on all that debt.
Which brings us to the interest coverage ratio. We take their operating income, or EBIT.
Earnings before interest and taxes.
Right. And we divide that by their interest expense. Basically, we're asking, how many times over can you pay your interest bill using the money you actually made from your operations?
And what's the danger zone here?
Anything below 1.5. If you're below that, you are essentially working for the bank.
Just generating enough to keep the creditors happy with nothing left over.
Exactly. Any small dip in sales and you default.
So, to wrap this all up, for you, the listener, it's about finding that balance. You need liquidity to survive the week, but you need solvency to own your future.
And this brings up a final kind of provocative thought. When you look at a balance sheet, you might find a company that makes just enough money year after year to pay the interest on its debt.
But never enough to actually pay down the principal or to invest or to grow.
They're not dead, but they're not really alive either.
That's the zombie company.
That's it. So the question to ask yourself is, are you looking at a business that's truly living or one whose heart stopped beating a long time ago?
Welcome to the deep dive. So let's start with a classic puzzle.
Okay, I'm ready.
You invest $1 million with two different CEOs. CEO A, she returns $100,000 in profit. CEO B returns $50,000. So who's the better manager?
Well, your gut just says A, right, more money.
Exactly. But the answer really depends on how they did it. We're not just looking at the final number. We want to look at the engine under the hood.
And that's our mission for this deep dive. We're unpacking the metrics that let you see the difference between, just good accounting and a genuinely powerful business machine.
We're basically grading management.
We are, on efficiency.
Okay, so where do we start? Let's talk about Wall Street's favorite, the initial screening tool. Return on equity, ROE.
Right.
The calculation is pretty simple, net income divided by shareholder equity.
Which really just tells you, for every single dollar you, the shareholder, invested, how many cents of profit did the management team actually generate?
And what's a good number? Is there a benchmark?
There is. The S&P 500 historically averages around, say, 14% ROE. But if you see a company that is consistently hitting 20% or more,
that's a new level.
That is a remarkable wealth creation engine. Those are the companies we call compounders. They're so good with your cash, you just want to hold them forever.
But, and this is a big but, there's a huge flaw in ROE. It can be gamed.
Oh, absolutely.
Let's go back to that CEO who made $100,000. What if they did that by borrowing $100 million?
Exactly. You can make your ROE look amazing by taking on massive debt. Because when you take on loans, the amount of shareholder equity, the E, it shrinks.
So your little piece of the company looks incredibly profitable.
Deceptively profitable. The bank is holding all the risk. It's like your slice of the house looks great, but the whole thing is mortgaged to the hilt.
So how do we see past that?
Well, that's why sophisticated investors, people like Charlie Munger, they pivot to a better metric. Return on invested capital, ROIC.
And what's the difference?
The difference is vital. ROIC looks at the return on all the money in the business, the debt and the equity.
Ah, so he doesn't care how the operation was financed.
Not at all. It tells you how efficient the actual business is, period. It's a measure of the engine itself, not the financing trickery.
So a high ROIC is a better sign of quality.
It's the financial fingerprint of a business with a strong moat. A consistent ROIC of, say, 15% or more that tells you management has built a real competitive advantage that's hard to copy.
Okay, so we've gone from capital structure to the health of the engine. What about just operational speed, how fast things move?
Right. How quickly can they turn stuff into cash? And for that, we look at inventory turnover.
Which is cost of goods sold over average inventory.
In other words, how many times a year does the company sell everything in its warehouse?
This feels like it gets right to the business model itself.
It does. I mean, just think about Costco versus a luxury brand like Tiffany & Company.
Completely different machines.
Totally. Costco's management, their whole strategy is high turnover. Move massive volume, fast, on thin margins. They sell the milk before it even spoils.
That speed is their efficiency.
Yes, but Tiffany's management, they choose slow turnover. A diamond ring might sit in a case for months. So for them, efficiency has to come from incredibly high profit margins to make up for that slowness.
So looking at turnover gives you the context for their strategy.
It tells you what kind of game they're playing.
Fantastic. So you've got these three key tools. ROE, the quick snapshot.
The market favorite.
ROIC, the true measure of the business engine.
And inventory turnover, which is the gauge of operational smarts.
Right.
And, this all connects back to a final, really provocative thought for you. It's about what's called capital allocation. It's the biggest job management has.
Deciding what to do with the company's profits.
Exactly. And if a company has a really high ROIC, say 25%, you should never want them to pay you a dividend. Ever.
Because they can grow that money better than I can.
They're proving they can grow it faster than you, so you want them to keep every penny and reinvest it. But if their ROIC is a mediocre, like 5%, they're destroying value.
Yeah.
They should give that cash back to you immediately.
So the question for you to really consider is this.
Are you unintentionally subsidizing mediocre management by letting them hold on to cash that you could be using much more effectively? Okay, let's dive into this. Today we're going deep on return on equity, ROE.
Right.
But we're not just looking at the number. We're trying to figure out how that one metric can be, well, a total liar depending on what's hiding underneath it. So here's the puzzle for you. Imagine three totally different companies, let's say. A luxury handbag brand, a huge grocery store, and a risky bank.
Wildly different businesses.
Exactly. And they all have the exact same 20% ROE. I mean, how is that even possible? How do we make sense of that?
Well, that's the thing. The number itself is almost useless without the context. That 20%, it's just the destination. It tells you nothing about the road they took to get there.
Okay.
And that's why way back in the 1920s, the DuPont Corporation invented their analysis.
Yeah.
So our mission today really is to look under the hood, to see why a company is profitable, not just how much.
So it's not one number. It's a framework. It breaks ROE down into, what, 3 parts that multiply together?
That's it. It's net profit margin times asset turnover times financial leverage. Those are the 3 levers. And they tell you a completely different story about where the profit comes from.
Okay, so let's pull that first lever. Net profit margin. What is that actually measuring?
Margin is the simplest, really. It's just how much profit you squeeze out of every single dollar in sales. It's all about uniqueness, pricing power.
So like our luxury handbag example.
Exactly. Think Hermes. They don't win on volume. They win because they can charge just a massive premium for their product. The brand is that powerful.
Got it. So high margin means high uniqueness. But then the second path, asset turnover, that sounds like the complete opposite. It's pure efficiency.
It's the efficiency model, 100%. Asset turnover measures how well you use your stuff, your stores, your inventory to actually generate sales. This is the Walmart strategy.
Razor thin margins.
Oh, razor thin. They make almost nothing on each can of beans, but they sell so much so fast that the sheer velocity, the turnover, gets them to that high ROE. They win on volume.
So the first two seem to show, real business quality. either a great brand or incredible operations. But then we get to that third lever, financial leverage.
And this one is the multiplier. This is the one you really have to watch.
This feels like where the risk comes in.
It's all risk. Leverage is just using debt-borrowed money to amplify the returns you're already making from your margins and turnover. Think of a bank or a hedge fund. They borrow huge sums to make their small operating returns look spectacular.
But wait, I mean, isn't some leverage normal? How do we separate that from what you're calling synthetic ROE? Is all high leverage a ticking time bomb?
That's the critical question. It's a time bomb when ROE is going up only because of leverage. So if margins are flat and turnover is flat but debt is spiking, that's synthetic ROE. The business isn't better.
It's just riskier.
It's just riskier. They're on a tightrope held up by borrowed money.
Wow. So for an investor, the real detective work is figuring out which lever moved when the ROE goes up.
That's it exactly. Did margins or turnover improve? Great. That's a positive sign. Better brand, better efficiency.
But if only leverage went up?
That's the warning sign. They're just borrowing to look good on the quarterly report.
And this leads right into that fake growth story from our sources, doesn't it? When a private equity firm buys some boring but stable company.
Like classic move.
They load it up with debt, which cranks up that third lever, and then they claim they improved performance because the ROE shot up.
It's a pure accounting trick. They haven't made the core business any better. They've just added a mountain of risk. If you use the DuPont analysis to strip that new debt out, you often find the actual performance is completely flat.
It's just a mask.
It's debt masking stagnation.
Yeah.
So it leaves you with a really important question to think about. If a company's high ROE is just a function of borrowed money, how can you truly measure how effective management is? What other metrics might be getting completely distorted by just turning up that debt lever?
That is definitely something to mull over. We appreciate you joining us for this deep dive. We'll see you next time. Welcome to the deep dive. Today, we're jumping right into one of the core tools in investment analysis. We're talking about relative valuation.
Right. It's the fastest way to size up a stock.
And it's probably the most common for a reason.
It is. It's intuitive. Think about buying a house. You don't, calculate the cost of the bricks and the lumber first.
No, you look at what the house next door sold for.
Exactly. You look at the comps. That is relative valuation.
So the logic is if a similar business is trading at, say, 20 times its earnings, and your target company, company B, is just plain better management, stronger brand, it should probably trade for more, maybe 25 times earnings.
That comparison is the whole game, but it goes deeper than just basic profit. We're going to unpack 3 key metrics that really clarify things.
Okay, let's do it. Where do we start? The big one, PE.
Let's start with the price-to-earnings ratio, the PE. Now, the first thing to know is there are 2 of them, which can get confusing.
Right, you see 2 different numbers for the same company all the time. Why is that?
It all comes down to one question. Is the number based on a fact or a guess? The trailing PE, that's based on the last 12 months of earnings. It happened. It's a fact.
Okay. And the other one?
The forward PE. That's based on what a bunch of analysts think the earnings will be in the next 12 months.
So a guess.
It's an educated guess, but yeah, it's still a guess.
So if a low PE is supposed to mean cheap, what's the trap in relying on that forward-looking guess?
The trap. This is it. A company can look incredibly cheap on a forward PE basis, but only because analysts are predicting some huge, amazing turnaround that, well, what if it never happens?
Then the earnings don't show up and the stock wasn't cheap at all.
Exactly. You were just betting on a guess that went wrong.
Got it. Okay, but the PE, even the trailing one, it has another problem, doesn't it? If you compare a sleepy utility company to a high-flying tech company, the tech stock always looks crazy expensive.
That's the classic problem.
Yeah.
And that's precisely why we have the PEG ratio, the price earnings to growth ratio.
The great leveler.
It is the great leveler. The formula is actually really simple. You just take the PE ratio and you divide it by the annual earnings growth rate.
And there's a simple rule of thumb here that's super useful.
Here is a PEG of 1.0 is generally considered fair value. Anything under 1 is, potentially cheap.
So this is the aha moment. A stock could have a high PE of, say, 30.
Right. And that sounds expensive. But if it's also growing its earnings at 30% a year, well, 30 divided by 30 is 1. Its PEG is 1.0. That's fair value.
And that's actually cheaper than a stock with a PE of 10 that's only growing at 5%.
Exactly. That second stock has a PEG of 2.0. It's expensive for the tiny amount of growth you're getting. PEG tells you the price you're paying for speed.
Okay, that makes perfect sense. So what's the third metric, the one that investment bankers love?
Right, the takeover multiple. We're talking about EV/EBITDA. The main flaw with PE and PEG is that they completely ignore debt.
Which is a huge deal if you're buying the whole company.
A huge deal, you have to pay off that debt. So we start with enterprise value, or EV. Think of it as the total sticker price,
Yeah.
the stock value plus all the company's debt minus any cash it has lying around.
So EV is the true purchase price. Then what's EBITDA?
EBITDA is the engine. It's a rough proxy for the raw cash the business generates before all the accounting stuff like interest and taxes.
So you're comparing the total price, EV, to the raw cash flow, EBITDA.
Precisely. The ratio tells a banker how many years it would take for the company's own cash flow to pay for its acquisition. It's the total cost of ownership.
All right, so to recap, we have the PE ratio, where you have to know if it's a fact or a guess. We have the PEG ratio, which levels the field by factoring in growth. And then EBITDA, the takeover multiple that includes debt.
You've got it. Those three give you a really powerful toolkit. But there's one crucial caveat to all of this.
Which is?
Relative valuation is great at finding a bargain relative to its peers. But it can't tell you if the entire market is in a bubble.
So in a bubble, you might find a stock that's cheap compared to its competitors, but the whole group is still dangerously overpriced.
That's the danger. It finds relative deals, not absolute safety.
So what does this all mean for you, the listener? What's the final thought here?
The question you should always be asking yourself when you see one of these metrics is simple. Is this number based on a solid, unchangeable fact from the past? Or is it based on a highly leveraged guess about the future?
That distinction really is everything.
Okay, so let's dive in.
Let's do it.
We're talking intrinsic valuation today. And really, that just means cutting through all the market noise, all the volatility,
Right.
to answer that one fundamental question. What is a company truly worth?
And that entire idea, it all really hinges on one core concept.
The time value of money.
Exactly. The idea that $1 in your hand today is worth more than the promise of $1 tomorrow.
Because you can invest it.
Because you can invest it. And that brings us to the main tool everyone uses to figure this out, the discounted cash flow model.
The DCF. It's known as the gold standard of finance.
It is. But it's a three-step process, and it's built on some pretty massive assumptions.
Okay, so what's step one?
Step one is basically grabbing your crystal ball. It's forecasting free cash flow.
So you're trying to predict how much actual cash the company will generate for the next, 5 or 10 years?
That's it. And if that initial growth assumption is wrong, the whole valuation it crumbles.
Really?
Think about it. If you were modeling, say, Blockbuster Video back in 2010.
Oh, yeah. Based on their past growth, you would have thought they were a sure thing.
And your valuation would have been utterly meaningless just a few years later.
Which, that seems like a huge problem for, a new tech company, doesn't it?
Yeah.
How can you possibly predict 10 years out?
That's a perfect lead-in to step two. This is the tool we use to, temper that optimism.
The discount rate.
The discount rate. You can think of it as your required rate of return.
How much you demand to be paid for taking on the risk.
Exactly. In finance, it's often the WACC, the weighted average cost of capital. For a really risky startup, you might demand a, say, 15% return.
So you're heavily discounting their future promises.
Heavily, but for a super safe, predictable company like Coca-Cola,
You might only need 8%. You're more certain that cash is coming, so you don't discount it as much.
you've got it. So once you've discounted all those cash flows for the first 10 years, that brings us to step three.
Terminal value.
Terminal value. This is where you have to estimate what the company is worth from year 11 to infinity.
To infinity. And this is the part that I think is it's wild.
Yeah.
This one number, this massive guess about the company's perpetual future, it often accounts for something like 70% of the total value in the DCF.
70%. Sometimes more. The vast majority of the company's calculated worth comes from this one giant estimate.
So after all that work, the model spits out this very precise fair value, right? Down to the penny.
Like $142.50. And the rule is simple. If the market price is $100, you buy.
If it's 200, you sell. It creates this false sense of certainty.
A very dangerous one. It all comes down to garbage in, garbage out.
So how fragile is that final number? Really?
It's incredibly fragile. This is what's so fascinating. If you just change one of your inputs, say you move the growth rate from 5% to 6%.
Just a single percentage point.
A single point. That tiny change can cause the final value to jump by a full 20%.
Yeah.
The precision of the spreadsheet completely hides how subjective the whole process really is.
So we have the gold standard model,
Yeah.
but it assigns most of its value to a huge guess about forever, based on these incredibly sensitive inputs.
That's the tension. So the final thought for you to consider is this. If we know that 70% of a company's calculated value comes from that infinity guess,
And we know that tweaking a single input by 1% can swing the outcome by 20%.
then how much confidence should you really place in that single precise number? What other valuation methods, maybe market multiples or comparable companies, must you also look at to truly feel comfortable with your decision?
That's the real question, something to keep mulling over.
Welcome back to the deep dive. So let's just acknowledge a core truth of the free market. Capitalism is, well, it's brutal.
It really is. If you find a way to make a high profit, you can bet competitors are coming for you.
They'll copy your product, they'll undercut your price, and they'll keep doing it until all that profit is just gone.
Exactly. And that's where this idea, this central concept of the moat comes in. Think of your company's profits as a castle.
Okay.
The moat is the structural advantage, that deep defensive barrier that keeps all those invaders out.
We're not talking about a good quarter or some slick marketing. We want to unpack the 4 real structural advantages, the things that define a real moat.
Let's do it.
So let's start with what might be the strongest moat of all, the network effect.
Oh, absolutely. This is the one that leads to those winner-take-all markets.
Yeah.
The idea is simple.
Mm-hmm.
The product gets more valuable to you as more people use it.
Right. Like Instagram or WhatsApp.
Exactly.
Yeah.
A better app could launch tomorrow, but it doesn't matter. Because all your friends, your family, your entire network, they're all on WhatsApp. So you can't leave. You're locked in.
So the network itself is the defense. Okay, so if that's about locking people in through growth, the second moat is about making it painful to leave, switching costs.
Yeah, this is all about creating friction, just pure pain and annoyance.
The consumer example that comes to mind is, Apple versus Android.
Perfect example. If you switch, you lose iMessages, you have to rebuy your apps, you have to relearn a whole new interface.
And that hassle is what gives Apple its pricing power.
It is. And that's just for us. Now imagine you're a massive company.
Like an enterprise business.
Think about enterprise software. Oracle, SAP, ripping that kind of software out of a business. It would literally shut it down.
That's a moat built on pure operational terror then.
It really is. Okay, so moving on. Let's talk about the simplest, most brutal defense.
Cost advantage.
Right. Just being able to sell cheaper than anyone else and still make money. It's all about scale.
You're talking about a Costco or a Walmart.
Exactly. They buy in such unbelievable volume that suppliers give them prices no one else can get.
So a local shop can't even buy its inventory for what Walmart sells it for.
They can't.
Yeah.
It's impossible to compete on price without going bankrupt. Their scale is the moat.
All right, so last one, intangibles. This is a bit fuzzier.
It is. It's about brand and legal protection.
Let's talk brand first. Nike is the classic case study, right?
It is. You could have 2 structurally identical shoes on a shelf.
One is $50, the other one has a swoosh on it, and it's $200.
That extra $150, that's the brand mode. Nothing more than the idea of the swoosh.
And what about the legal side?
That's where patents come in. Think of pharmaceutical companies. A patent gives them a legal monopoly on a drug for 20 years. Competition is literally against the law.
Okay, so we've laid out these 4 shields.
Yeah.
But, what does this all mean for you listening? Because moats are not permanent.
And that's the most critical lesson here, this idea of the eroding moat.
What's a good example of that?
Look at Kodak. They thought their brand was an unbreakable moat.
Everyone knew Kodak.
They did. But digital cameras came along and just washed it all away. Or newspapers, they thought their distribution trucks, their printing presses were a huge barrier.
A physical moat.
A huge physical moat. And the internet just jumped right over it, made that entire advantage totally irrelevant almost overnight.
So we'll leave you with this final thought. Given those examples, what seemingly unbreakable moats today? What network effect or switching cost might be on the brink of being jumped over by some new technology?
That's the question to analyze.
That's your assignment until our next deep dive. All right, today we're jumping into a quick but really essential deep dive. We're looking at those little mental cheats, the cognitive shortcuts that are probably costing you money in the markets right now.
It's a fascinating premise, really. Our brains, they evolved for survival on the savannah, not for trading derivatives.
Right.
So these shortcuts, they're meant for efficiency, for quick action.
To keep us from getting eaten by a lion, basically.
Exactly. But when you apply that to complex financial markets, well, that's where those same shortcuts can absolutely destroy your returns.
So our monkey brains are getting in the way.
That's a perfect way to put it. They're costing us thousands.
Okay, so what specific shortcuts are we dealing with today?
We're going to focus on two of the most powerful ones, anchoring and confirmation bias.
Let's start with anchoring. So this is the one where your mind just gets, I guess, stuck on the first number it sees?
Completely stuck. We call it the price memory trap, and it is incredibly powerful.
And the classic scenario, I think everyone listening has felt this before.
Oh, definitely.
You buy a stock at, let's say, $100. Then the market has a bad week, and suddenly it's trading at 80.
And what's that immediate instinctive thought?
I am not selling this for a loss. I'll sell when I break even, when it gets back to 100.
That's the anchor. That $100 price point, it becomes this totally emotional benchmark that has nothing to do with the company's value today.
But hold on, isn't that historical price useful at all? If I bought it at 100, shouldn't that inform my current thinking?
Only if you're worried about your ego. The hard truth is the market does not care what you paid.
Right. It has no memory.
Zero memory. The only reality that matters is the current price, the $80. By anchoring to that old number, you're making decisions based on the past, not the future.
So how do we break free? What's the antidote here?
There's a really simple but powerful question you have to force yourself to ask.
The $80 question.
Exactly. You have to ask, if my portfolio was 100% cash right now, would I buy this stock today at $80?
And if the honest answer is no,
you sell it immediately, regardless of what you paid. That's how you snap the anchor.
that makes a lot of sense. And I can see how that leads right into the next bias, confirmation bias.
They're deeply connected. I mean, if you're anchored to that $100 price, you're going to start desperately looking for reasons to believe it'll get back there.
So this is the echo chamber effect.
Yeah.
You're basically filtering reality to fit what you want to be true.
Aggressively filtering it. You seek out information that agrees with you, and you actively ignore or dismiss anything that contradicts you.
Like with a really controversial company, say Tesla?
A perfect example. You buy the stock, you're excited, and so you only follow the super bullish accounts on Twitter. You only read the positive analyst reports.
And when some genuinely bad news comes out, like a poor earnings report,
It's just FUD. Fear, uncertainty, and doubt. Or you decide it's big conspiracy by short sellers trying to manipulate the price. It couldn't possibly be a real problem.
the danger there is you become blind to actual risks until it's way too late. I see this accelerate with that form fanatic phenomenon on Reddit or Discord.
Exactly. In those groups, dissenting opinions are often just banned. So you're left with this dangerous feedback loop where everyone agrees with each other.
A dangerous feedback loop leading to...
Well, it can often lead to a form of financial suicide.
Mm.
If you only listen to cheerleaders, you are structurally unprepared for a market correction.
So what's the antidote for the echo chamber?
It's something called the kill thesis challenge.
Okay, that sounds intense.
It is, but it works. You have to actively go find the smartest person who hates your stock and deeply listen to their argument.
And if you can't dismantle their points with cold, hard facts...
If your only defense is that's just FUD or it's a conspiracy, you should not own that stock. You're in the danger zone.
So when we tie this all together...
Understanding these evolved shortcuts, anchoring on old prices, confirming what you wish was true, it's just absolutely crucial for financial success. But, knowledge is only valuable when you apply it.
And that's a great place to leave it. So here's a final thought for you to mull over. If the current price is the only reality that matters, how many decisions are you making right now based not on that reality, but on what you wish you had paid? Go test your current holdings. Use that $80 antidote question this week. The answer might just surprise you. All right, welcome to the deep dive. Today we're getting into something that affects every single person with a dollar to their name: financial psychology.
Yeah, specifically, we're looking at why we get so irrational when money's on the line. We're pulling from some really foundational source material on loss aversion and sunk costs.
These are the two big ones, right? The twin demons, so to speak.
They really are. And to get it, you have to start with this core finding from psychologists Kahneman and Tversky. It's an asymmetry in our emotions.
Okay.
The pain you feel from losing, say, $1,000 is scientifically, reliably, about twice as intense as the joy you feel from gaining that same $1,000.
Twice as intense. So we're not wired to be neutral at all.
Not even close. And that one fact explains so much. It means your main driver isn't actually maximizing your gains.
Minimizing the pain.
Exactly. It's minimizing that emotional discomfort. And that leads us right to the first big fallacy, loss aversion.
Okay, so let's make this real. Imagine you open your portfolio right now. You've got two stocks.
Yeah.
Stock A, it's doing great. It's up 20%. And then you have stock B, which is, well, it's down 20%. The gut instinct is immediate, isn't it?
Oh, it's so powerful.
Yeah.
The impulse is to sell stock A. Lock in the win, get that little hit of dopamine. It feels good.
It feels safe.
It feels safe. And you hold on to stock B. Why? Because selling it means you have to make that loss real. You have to actually admit it.
And that's the pain our brains are wired to avoid. But wait, what's so wrong with taking a win off the table? I mean, a gain is a gain.
Emotionally, it feels right. But financially, over the long term, it's disastrous. You end up doing the exact opposite of what you should.
You're cutting your flowers and watering your weeds.
You're cutting your flowers and watering your weeds. You sell the very things that have momentum, and your portfolio just slowly, quietly fills up with your losers.
Because you couldn't stand the thought of taking that initial loss. Okay, that's a huge lesson right there. That same feeling, that aversion to pain, it drives the second trap too, doesn't it?
It does, but in a slightly different way. This is the sunk cost fallacy. And this one isn't just about market loss. It's about admitting your effort was wasted.
Okay. The ego.
It's all ego. You continue doing something just because you've already invested time or money or, emotional energy into it.
So let's use that biotech example. You spent maybe 50 hours researching some niche company. You loved it. You bought the stock. And then bad news hits.
Right. The FDA rejects their main drug. The stock tanks 40% overnight.
And the trap snaps shut.
The trap snaps shut.
Yeah.
Because the voice in your head says, I can't sell now. Look at all the work I put into this. I know this company.
You're confusing past effort with future potential.
Perfectly put. The reality is that 50 hours of research, it's gone. The original price you paid. It's completely 100% irrelevant to whether that stock goes up tomorrow.
So what's the antidote? How do you break free from that?
There's a really powerful mental trick. It's called the zero-base method. You have to imagine that your entire portfolio was liquidated, sold for cash, tonight. Tomorrow morning, you wake up with a pile of cash.
A clean slate.
A totally clean slate. Now, you ask yourself, with this cash, would I go out and buy that crashed biotech stock today?
And if the answer is no,
then you're a victim of the sunk cost fallacy. You have to sell it and move that capital to something you would buy today.
when you put it like that, it's so clear. Both of these ideas, loss aversion and sunk cost, they're mechanisms to avoid the psychological pain of admitting a mistake.
That's all they are.
So let's leave our listener with one final thought on this, a practical application.
Yeah, if you take this logic, you realize that maybe the most dangerous goal in all of investing is the break-even fantasy.
What do you mean by that?
It's that feeling of, I just have to hold on until I get back to even, just to erase the loss. That one goal prevents you from ever using the zero-base test. It locks your capital in an underperforming asset, stopping you from finding a new opportunity that could actually make you real money.
So the question to leave everyone with is, are you trying to make money, or are you just trying to avoid admitting you were wrong?
That's the thought. If you've ever taken a basic finance class, you've had one rule drilled into your head. It's the one that governs, well, everything.
Higher risk equals higher reward.
Exactly. If you want a higher reward, you have to take a higher risk. That's the deal.
Huh.
But here's where it gets really interesting, because today we're diving into a paradox.
Some people call it the free lunch of modern investing.
The free lunch, right. And what's so fascinating is that while that rule is true for, any single asset, it has this huge multi-billion-dollar loophole when you start combining them.
And that discovery changed everything. It completely altered how professional money managers and big institutions handle their portfolios.
And the person who blew up that old model was Harry Markowitz. And you have to picture this. It's 1952. He's a 25-year-old grad student.
Just a kid, really.
And he submits this paper that essentially proves that basic risk-reward equation isn't some unbendable law of the universe. His work became the very bedrock of what we now call modern portfolio theory.
MPT. And it won him a Nobel Prize for it decades later.
As it should have.
Well, the core insight of MPT is it's genuinely revolutionary. You can take a bunch of risky assets, combine them in a very specific way, and the portfolio that comes out the other side actually has less overall risk.
Without just tanking your return.
Exactly. Without necessarily sacrificing your expected return. That's the optimization. So our mission today is to unpack the tool used to visualize all this, the efficient frontier.
Okay, let's unpack this visual. So imagine a simple graph for us. The vertical y-axis, that tracks your reward.
Your expected annual return.
Right. And the horizontal x-axis, that's tracking risk. And in MPT, they measure that using something called standard deviation.
Mm-hmm. And for anyone who's not familiar, standard deviation is really just a technical way of talking about volatility.
How much things swing up and down.
That's all it is. How much the price of that investment is expected to swing. So a bigger swing means bigger risk. And when you plot every single possible combination of assets on this grid, you don't get a random cloud of dots.
No, you get a sharp, almost bullet-shaped curve.
That's right. And that curve exists because assets don't all move up and down together. They don't move in perfect sync.
Which is the whole point.
Yeah.
So tell us about the top edge of that bullet shape. That's the frontier, right?
That top boundary is the efficient frontier. If your portfolio sits right on that line, you are optimized. You are getting the absolute maximum possible return for that specific level of risk.
And if you're below the line,
then you're inefficient. You're taking on way too much risk, too much volatility for the return you're actually getting.
Okay, so what about above the line?
Well, that area is mathematically impossible. You can't get that level of return with that little risk. Unless, as our sources point out, you just ignore the math entirely, like Bernie Madoff and lying.
Right. So that makes the goal for you, listening to this, perfectly clear. We want to move your existing portfolio up and to the left on that chart.
Most people are inefficient. The portfolios are sitting way below that line, kind of trapped in that high-risk, medium return zone.
And this is where that big blind spot shows up, isn't it?
It is. The optimization strategy isn't about just picking, better stocks by themselves. That's what everyone does by default.
The individual asset focus.
Right. The problem is when smart investors look at each thing and say, oh, Apple is a quality company or Tesla is a quality company, but they don't ask the most important question.
It is.
How do they interact when the market is crashing?
It's like trying to build a championship football team with 11 amazing quarterbacks.
Perfect analogy.
I mean, individually, they're all fantastic assets, but put them on a field together, and they're going to fail spectacularly against a decent defense.
Because there's no balance. You need assets that disagree with each other. You need some things that zig when other things zag. That's what lowers the volatility of the whole system.
MPT forces you to shift your focus away from just judging the quality of the individual parts.
And toward understanding how all those parts interact. You're maximizing returns by actively managing the volatility across the entire system.
So if even highly trained professionals and, brilliant analysts can have this blind spot looking only at the quality of each piece instead of the harmony of the whole system, it raises a pretty interesting question. What other areas of life or work might suffer from this exact same failure, this inability to look for the optimized system instead of just collecting excellent components? What stands out to you?
Okay, let's get into it. Today we're going to unpack a concept that's absolutely foundational if you want to get anywhere near that, that holy grail of investing, the efficient frontier.
It's the engine, really. The whole idea of getting the most return for the least risk, it all comes down to this one thing.
And that one thing is correlation.
Exactly. It sounds a bit academic, but it's really just a number. It goes from -1 to +1, and it just measures how two different assets move in relation to each other.
And to really make this stick, I think we have to start with that classic analogy, the island vendor.
Ah, yes, the perfect mental model. So imagine you're on an island. You have a business.
Two businesses, actually. Let's say asset A is sunglasses. When it's sunny, you're making a ton of money. When it rains,
We're making nothing, zero.
yeah,
And asset B is, of course, umbrellas.
the complete opposite. So if you only own one of those, your income is, well, it's all over the place, super volatile.
Huge peaks, deep valleys, high risk.
But, and this is the magic moment, what happens if you own 50% of the sunglasses business and 50% of the umbrella business?
Your income becomes perfectly smooth. Whether it's a heat wave or a monsoon, you are making steady money.
And that's the key takeaway for you listening. You haven't actually sacrificed your total expected profit. All you've done is smooth out the ride.
You've just massively, massively reduced your risk. And that, right there, is the entire point of diversification.
So that's the ideal scenario, the perfect -1 correlation. But let's break down the whole spectrum.
Right, because it's not always so perfect. You can think of it in 3 key points. First, you have a correlation of +1.0.
Perfect positive correlation.
Exactly. The assets move in perfect lockstep. Think of, say, 2 different big oil companies.
Yeah.
The price of oil drops, they both drop together.
So the diversification benefit is what?
0. Absolutely none. You haven't diversified, you've just doubled down on the same bet.
Okay, and then at the other end, you have our umbrellas and sunglasses, -1.0.
The Holy Grail. Perfect negative correlation. One goes up, the other goes down. That gives you the maximum possible risk reduction.
But what about the middle? What about 0?
Right, 0.0 correlation. And this is where it gets really interesting and, frankly, more realistic for building a portfolio. These are assets with no real relationship.
Like what?
The sources use the example of gold prices and Microsoft stock. There's no fundamental reason why the movement of one should dictate the movement of the other.
Wait, so if they're just moving randomly relative to each other, why is that so good? It doesn't seem as powerful as the perfect -1.
Because you're combining assets that both have positive expected returns, but their random movements tend to cancel each other out. You're getting a huge risk discount, almost for free. It's the sweet spot for portfolio construction.
That makes a lot of sense in theory, but this is where we run into what the source material calls the hard truth.
Yes, the hard truth.
All this beautiful math about diversification.
Yeah.
What happens when a real crisis hits?
It breaks. In a massive financial panic. Think 2008. Think the COVID crash in March 2020. Correlations do something terrifying. They all collapse towards +1.0.
Everything goes down together.
Everything. Because the driver is no longer fundamentals. It's panic. It's a system-wide demand for cash.
So people aren't just selling their bad assets.
They're selling everything. Stocks, bonds, gold, crypto. They're selling the winners and the losers because they need liquidity. It's like the island vendor suddenly having to sell both the umbrella and the sunglasses stand just because he needs cash right now.
Wow. So diversification fails you at the exact moment you need it the most.
It can. That's the fundamental challenge here. The theoretical benefit is massive, but the real-world panic factor can override the math entirely.
So as we wrap this up, the message for you is that understanding correlation is absolutely key.
But you also have to understand its limits. And maybe that's the final thought here. If correlation is the measure of how assets move, we also have to account for the psychological correlation of panic. It's this invisible force that grabs completely unrelated assets and pushes them all toward +1.0. That's the real monster the deep dive investor has to face.
Welcome to the deep dive. Today our mission is, well, it's to give you a real scorecard for telling skill apart from just pure luck in the financial world.
Which is the essential question.
Exactly. I mean, you see a fund manager with this spectacular return and you have to wonder, are they a genius? Or did they just ride a huge market wave? Okay, let's unpack this with an example. A fund manager boasts a, say, 20% return in 1 year. Sounds incredible.
On the surface, absolutely.
But what if the whole market, the S&P 500, our baseline went up 25% that same year?
Well, then that manager didn't just underperform. They actively lost you money compared to just buying a simple index fund.
Right. We need a much better way to measure that gap. And that's where 2 Greek letters come into play, beta and alpha.
And beta is really the starting point for all of this. It's the measure of market risk. You know how bouncy a stock or a whole portfolio is compared to that broad index.
It's the return you get just for showing up.
It's the return you get for taking the ride on the market wave, yes.
We found a great analogy for this. Think of beta as the type of car you're driving. So a beta of 1.0.
That's your standard family sedan. It moves exactly with the market. If the market is up 1%, your stock is up 1%. It mirrors it.
Yet then you have the extremes.
Exactly. A beta of 2.0. Now that's a sports car. It's twice as volatile. You'll get there faster when the road is clear.
But if the market crashes...
You crash twice as hard. And on the other end, you've got a low beta, maybe 0.5. That's your defensive minivan. Think utility companies or big retail stores.
So half as volatile, safer on those rough roads.
Much safer. So beta is just the return you get for the risk you choose to take in the market.
Okay, so that's beta. It's the risk we take on, but we pay these managers for their skill. We pay them to find alpha. What does that actually look like?
What's fascinating here is that alpha is everything else. It's the excess return, the part that's earned above what beta predicted.
So it's the pure skill.
It's the pure skill. It's that moment of insight, the manager seeing something that nobody else does.
But wait, if it's that hard to find, why are we even bothering to measure it? It feels like a way to justify really high fees for something that might not even be there.
That's the critical question, and it's why we measure it.
Yes.
We have to know if they're actually adding value. The simple calculation tells the story.
Okay.
Let's say the market is up 10%. Your portfolio has a beta of 1, so it should have returned 10%.
Right. It should have just matched the market.
Exactly. But if it actually returned 12%, that extra 2%, that's your alpha. That is the skill premium you paid for.
That sounds pretty clean on paper. What's the reality check, though? How often does that happen?
The reality is pretty sobering. The data we looked at is very clear on this.
Mm-hmm.
Finding true sustainable alpha is incredibly rare.
How rare?
So rare that most actively managed funds actually show a negative alpha once you factor in their fees and costs.
Wow. So you're not just underperforming. You are literally paying someone a fee to lose to the market for you.
Precisely. You're paying them a premium, sometimes 1.5%, 2%, for a fee structure that almost guarantees they'll fall behind a simple index. You're paying for market risk, that's beta, but the supposed skill you're paying for actually just drags you down.
So it's like paying for a racing stripe on that minivan, and the stripe actually makes it slower.
That's a perfect way to put it.
If we connect this to the bigger picture, then, this must be why passive investing has gotten so huge.
It's the entire reason. You see, beta is what you can get for almost free, just market exposure. Alpha is what you pay a premium for, that supposed managerial skill.
And passive investors are just saying, I'll take the beta.
They're saying, I'm happy with a beta of 1 and an alpha of 0. They're completely fine with 0 alpha because it means they also avoid the high fees that usually lead to negative alpha.
This really gives you a powerful new way to look at your investments. It's not just about the big return number anymore. It's all about the context behind it.
Mm-hmm.
Which leaves us, and you, with one final provocative thought. Since real alpha is so hard to find and fees so often guarantee a negative result, ask yourself this. When you look at where your money is going, how can you tell if you are paying for actual skill or just for some very expensive luck? That question should change how you read your next investment statement.
All right, so we're diving into your source material on fixed income, and our mission today is pretty clear. We want to pull out the operating manual for the bond market.
Yeah, for the financial bedrock that nobody really talks about.
The silent giant of global markets.
It absolutely is. If you think about a portfolio, stocks are the engine, right? That's the growth. But bonds are the airbag.
The airbag. I like that.
They're there to absorb shock, to prevent, a total catastrophe. And just to frame this, the global bond market is actually larger than the stock market.
Which is a fact that I think blows most people's minds. It really sets the stage for how important this is.
It's the infrastructure for everything else.
Okay, so to understand that infrastructure, you have to get one thing down. It's the single most important rule, and it's a little counterintuitive at first, the inverse relationship.
We call it the seesaw principle. It's actually pretty simple when you break it down. When interest rates out in the world go up, the price of your existing bond has to go down.
It's just math.
It's just math. It has to.
So let's run the numbers from the sources just to make it crystal clear. Say I bought a bond last year and it pays me 2%.
Okay, you're holding a 2% bond.
But then today, the Fed hikes rates and suddenly all the new bonds being issued are paying 5%.
Well, who would ever pay you full price for your little 2% bond now?
Nobody.
Exactly. To sell it, you have to put it on clearance. You have to drop that sticker price.
And that price drop is what makes the yield work out for the new buyer, getting them up to that 5% market rate.
That's it. The price has to move to compensate. So rates up, price down, the seesaw.
So if the price is all about where rates are, then the kind of bond you buy is obviously critical. Let's talk about the components. Your sources laid out 3 main categories.
Right, and we have to start with U.S. Treasuries. These are the safety baseline for the entire financial world.
Because they're backed by the U.S. government.
The ultimate IOU. When things get scary, this is where everyone runs. You've got short-term T-bills and then the longer T-notes and T-bonds for, locking up your money for decades.
Okay, so from maximum safety, we step onto the risk spectrum with corporate bonds.
And it's a wide open spectrum. You have rock-solid companies, that's investment-grade debt. Safe, but the yield is lower.
And then you have the other end.
The other end, high yield, or as most people call them, junk bonds.
Right.
These are from companies with shakier finances. To get you to take that risk of them defaulting, they have to pay you a much, much higher interest rate. Pure risk reward.
And then the third category is a bit unique. Municipal bonds or munis?
Munis, yeah, issued by cities, states, that sort of thing. And they have a superpower.
Which is?
The interest you earn is very often completely free from federal income tax.
So for certain investors, that's a huge deal.
For high-income earners, a slightly lower tax-free yield can easily beat a higher, fully taxed yield from a corporate bond. It's a game changer.
So this all brings us to the big picture. When we look at the rates for all these different durations, short-term versus long-term, what does that tell us? We have to talk about the yield curve.
Yes. Normally, the curve slopes up. We call it the normal curve. It's logical, right?
Yeah.
You should get paid more interest for locking your money up for 30 years than for 6 months.
You want to be paid for that long-term risk and uncertainty.
Of course. But the sources all point to this one terrifying scenario.
Yeah.
The inverted curve. When the whole thing flips upside down.
And that's when short-term bonds are suddenly paying more than long-term bonds.
Exactly. Think about what that means. It means investors are so profoundly worried about the next year or so, so worried that they will accept a lower payment just to lock their money away safely for 10 or 30 years. They're basically paying a premium to hide from the near future.
And here's the aha moment. This isn't just a theory. An inverted yield curve has predicted nearly every single recession in modern history.
It is the market's single loudest fire alarm. It says trouble is coming, and soon.
So to recap, bonds are the airbag, the seesaw rule is absolute, and the yield curve is the market's crystal ball.
That's the core of it.
So let's leave our listener with a final thought. If an inverted curve is a signal of near-term fear, what would a really steep, perfectly normal upward-sloping curve suggest? If it stays that way for a long time.
It would suggest massive confidence in long-term global stability.
Exactly. Not just for next year, but for 20 years from now. So the question is, if we were in that state of high confidence, what kind of shock, what kind of event would be big enough to break it all at once and flip that entire structure upside down? Something to watch for. Okay, so for today's deep dive, we're getting into a topic that's all about passive income. Real estate investment trusts. REITs.
And the material we dug into framed it with a line I just loved.
Oh, I know which one you mean. The landlord without the toilet repair.
Exactly. It immediately gets to the heart of the matter, doesn't it? You want the income from property, but nobody wants that 2 a.m. call about a leak.
No, absolutely not. So our mission here is to unpack how REITs let you do that, basically own property through the stock market. We'll hit 3 main things.
Right. The legal structure, liquidity, and how they handle inflation.
So let's start with the basics. A REIT is just a company that owns property that makes money. Think apartments, malls, that sort of thing. But what's the critical difference between a REIT and just some other company on the stock market?
It really boils down to a legal requirement, a regulatory rule.
Okay.
To even qualify as a REIT, and this is key, this is how they avoid paying corporate income tax. The law mandates they distribute at least 90% of their taxable income to shareholders.
90%. Not just revenue, but taxable income.
Precisely. So they are essentially forced by law to act as a pass-through for income directly to you.
And that forced payout, that completely changes the whole investment, doesn't it? They aren't hoarding cash for some future project.
Nope, they can't. They are legally obligated to send it your way as dividends, which is why you often see these REITs with, dividend yields that are way higher than the rest of the market.
Okay, so you have this high yield structure. But that income stream is only useful if you can get to it. And physical real estate is famously difficult to sell.
Oh, it's the definition of illiquid. Selling a building takes months. There's so much paperwork and the fees are huge.
Right. But with a REIT, you get that instant liquidity. It's traded just like a stock.
The convenience is just staggering. I mean, you can literally buy $50 worth of the Empire State Building on your phone in 2 seconds.
And sell it just as fast.
Yeah.
That mobility of capital is a massive advantage for the individual who wants that exposure without being trapped.
And that connects to the bigger economic picture, too. REITs are considered a real asset.
Meaning they're physical things, bricks and mortar.
Exactly. So when inflation kicks up, the cost to build a new building, the lumber, the concrete, all of it goes up. The value of the existing property rises.
But more importantly, the rents go up too, right?
That's the real key. Rents adjust upward with inflation.
Hold on, but our source material brought up a good point.
Yeah.
Doesn't the cost to borrow money also spike during inflation? Real estate is built on debt.
That's a great point, and it's a crucial distinction. Yes, rising interest rates make new deals more expensive.
Sure.
But the existing properties, the ones financed years ago with fixed-rate debt, their income stream is now rising while their biggest cost, the mortgage, stays flat.
So the cash flow actually improves.
It does. And that helps protect your purchasing power far better than just holding cash or, say, long-term bonds.
So the asset is this physical thing. But what we define as valuable real estate is changing so fast. I mean, 20 years ago, the sources said mall REITs were kings.
They were the absolute titans of the sector. Everything was about physical retail.
And now?
Now that's been completely flipped on its head. It mirrors the whole economy shift online.
So what are the new powerhouses?
We're talking about data center REITs, basically these giant secure warehouses that house the servers for the internet, and cell tower REITs.
It's kind of wild. The value used to be in the physical store where you bought a t-shirt. Now it's in the physical tower that delivers the Netflix stream to your phone.
It just shows you that real estate is simply the physical foundation for whatever the current economy is built on.
So let's bring it all home for you. What does this mean? You get high yields because of that 90% payout rule.
You get instant liquidity, which you'd never get with a physical building.
And you get a real hedge against inflation because rents rise.
And this whole shift, from malls to data centers, it really leaves you with a final question to think about. Well, what essential digital service today, maybe it's AI, maybe it's something at the blockchain, is going to need a brand new type of physical real asset foundation tomorrow? Because that's where the next big opportunity in this space is going to be. Welcome back to the deep dive. Today, we're getting physical. We're stepping away from the paper trail of stocks and bonds.
Right.
Our mission is to really get the difference between financial assets, promises on paper, and hard assets.
Which is quite literally stuff you can drop on your foot.
Exactly.
And that's not just a cute definition. The sources we looked at make it clear this is about understanding what they call the chaos hedge.
A chaos hedge.
Yeah. This isn't really about aggressive profit. It's insurance for survival. It's about assets that hold value outside the whole system.
For if or when that paper world fails.
That's the idea.
Okay, let's unpack this. We have to start with the king of hard assets, right? Gold.
Always.
What's so powerful is the duality of it. The case for gold seems so simple. It's been money for, 5,000 years?
5,000 years, yeah. And crucially, no central bank can just print more of it.
So it's the ultimate hedge against hyperinflation.
That's the case. But the argument against it is just as strong. I mean, it produces nothing.
Right. No cash flow, no dividends.
Minimal industrial use, really. You have Warren Buffett, who famously hates it. He had that great quote.
Oh, yeah. Just sits there looking at you.
Exactly.
So if Buffett's logic is that solid, what's the one statistical reason it stays in so many professional portfolios?
It's one word. Correlation.
Mm.
Or a lack of it.
Okay.
Gold is highly uncorrelated to stocks.
Okay.
So when the market crashes and everything is sinking, gold often zigs.
It's the insurance that pays out exactly when you need it most.
That is its entire job in a modern portfolio.
Okay, so that's gold, the fear gauge. But what about assets like oil, wheat, or copper? Are they telling a different story?
A completely different story. Gold is a lagging indicator. It reacts to fear that's already there.
Okay.
Industrial commodities are leading indicators. Their prices are just pure real-world supply and demand. They're cyclical.
And in that group, we kept seeing the name Dr. Copper.
Yeah.
That sounds like something out of a pulp novel. Why the PhD?
Well, because copper is in practically everything.
Houses, cars.
Your phone. It's essential for global construction, for manufacturing. So if the price of copper suddenly starts crashing,
It means people have stopped building things.
it means the global economy is slowing down fast. It's a real-time health check on global demand.
So if someone listening decides they want this kind of protection, how do they actually get it? The sources outline two main ways.
Right.
The first, futures contracts. It sounds extremely dangerous for beginners.
It is. It's the pure way to play it, betting on next month's oil price. But you can lose your shirt very, very quickly.
So that really leaves the more common approach, commodity stocks.
Yep. You buy the producers, an ExxonMobil for energy, a Barrick Gold for gold.
And that's generally safer. Plus, these companies can pay dividends, right?
That's the big benefit, yeah. You can get paid to wait.
But wait, before anyone runs off to do that, we have to talk about the catch. There's a fundamental trade-off.
A huge one. It's called company risk. You have to remember what you're buying.
You're not just betting on the price of gold itself.
Not at all. Let's say gold rises 10%. Great. But what if the specific mining company you bought has a catastrophic mine collapse?
Or just terrible management.
Exactly. The commodity did what you wanted, but your stock goes to zero. You're exposed to business risk, not just the price.
Which brings us full circle. The big takeaway here seems to be that commodities are about protection, not necessarily profit.
It's a hedge against systemic failure.
So the final question for you listening is, what does this all mean for you?
And that raises, I think, a really provocative question, right, from the sources we looked at. If you are truly investing for a chaos hedge, where do you draw the line between a financial hedge and, well, physical necessity?
What do you mean by that?
I mean, do you really want gold ETF shares that are just numbers on a computer screen somewhere? Or are we talking about the extreme edge?
The actual canned beans and ammo.
That's it. That's the ultimate calculation you have to mull over when you think about true catastrophic insurance.
Welcome back to the deep dive. So today we're going to skip past the basic ingredients, the stocks, the bonds, and get right to the recipe itself, how you actually mix all those things together.
Exactly. And this isn't a small decision. The sources we dove into suggest this one choice determines a staggering 90% of your lifetime returns.
90%. Wow.
It's huge. And the key is understanding that there are really two distinct layers to this decision. And if you can get that difference, you can stop that frantic checking of the financial news every single day.
Okay, so let's get into it. The sources talk about two layers. We've got the map, and then we've got the detour.
Precisely. The map is your strategic asset allocation.
The long-term setting.
The long-term setting. It's your baseline, designed to last for decades, and it's based only on things like your age and your personal tolerance for risk.
So it's specifically designed to ignore the headlines.
Completely. And that's where its power comes from, that 90% figure. It's not from predicting the future. It's just from simple compounding consistency.
Okay, so if it's that important, what does one of these strategic maps actually look like?
Well, it dictates the big standards we all hear about. The classic one is the 60-40 portfolio.
60% stocks, 40% bonds.
Right. And then you have something more like the age rule, which suggests you hold your age as a percentage in bonds.
That age rule seems, I don't know, a bit conservative now, doesn't it? I mean, the sources mention a 20-year-old having an 80-20 split, which sounds right. But a 70-year-old with 70% in bonds, with lifespans getting longer, that feels like you're leaving a lot of growth on the table.
It's a very fair question, and the sources do acknowledge that tension. But you have to remember the goal of the strategic map. It prioritizes avoiding a catastrophic loss over squeezing out every last gain. It's about setting the guardrails.
Okay, so those are the guardrails. Let's talk about stepping outside of them, the detour.
Yeah.
This is tactical asset allocation.
Right. The tactical move is a short-term, intentional deviation from your baseline, and is based on what you perceive is happening in the market right now.
So let's use an example. My strategic map says 60% stocks, but I read the news and I think, uh-oh, the market's in a bubble.
Exactly. Your tactical move might be to say, okay, I'm shifting down to 50% stocks, 50% bonds, just to play defense for a while.
But that's just market timing. And that's notoriously risky.
It is. The real danger is what you miss if you're wrong. You might avoid a dip, but if the market keeps ripping higher, you've lost years of compounding.
A mistake that could be much worse than the dip itself.
Far worse. That's why the guideline from most advisors is to keep these tactical detours really modest. We're talking plus or minus 5, maybe 10% from your baseline.
A tweak, not a total overhaul.
It's a detour, not a new map.
So this sets up a fundamental conflict then. You have this disciplined, boring strategic plan on one side.
This is so-called lazy portfolio.
Right. And on the other, you have this active, tactical genius who's always tweaking things. So is one lazy and the other smart.
Well, this is where the data is actually pretty humbling. The lazy portfolio, the one that just sticks to the map, it usually beats the active optimizer.
It wins. Why?
It's not because the tactical genius isn't smart enough. It's because the consistent, boring strategy is the best defense against the #1 portfolio killer.
Which is?
Yourself, your own emotions, panic selling in a crash, or buying into a bubble at the top.
So the rigid plan is really a safeguard against our own worst instincts.
That's it, exactly.
That distinction really clarifies so much. You have to know what your map is before you can even judge if a detour is worth the risk.
Right. And that really brings us to the final thought we want to leave you with. If this strategic allocation is so powerful because it forces you to ignore the noise and your own emotions, then the real question isn't just what's my asset mix, it's this. Given that emotional errors sabotage returns, what is the value of a financial strategy that actively requires you to ignore the daily headlines?
Welcome to the deep dive. Today we're getting into something that is just a critical lesson in managing your own financial risk. The idea of rebalancing.
Yeah.
And our sources all point to this core problem that it solves. It's this counterintuitive truth. Your gut tells you, let your winners run, right?
Mm-hmm.
But the actual math, the portfolio math, says you have to trim your winners just to manage your risk. It feels like a fight against your own human nature.
It absolutely is.
Yeah.
And the definition is so simple. Rebalancing is just the act of realigning the weights of your assets back to where you started.
Back to the original plan.
Exactly. The mission here isn't to predict the future. It's just to make sure you're taking the amount of risk you actually intended to take.
Okay, so let's unpack this mechanism. I think the classic 50-50 stocks and bonds example really illustrates it well.
Yeah, it's perfect.
So you start with a 50% stocks, 50% bonds portfolio. Let's say stocks have a great year, they go up 20%. And bonds, well, they just stay flat. The natural result is your portfolio has drifted. It's not 50-50 anymore. It's now, closer to 60% stocks and 40% bonds, just from that one good year.
And that drift, that seemingly small change, is where the danger lies. Your portfolio is now taking on way more risk than you signed up for.
And you didn't even do anything.
You did nothing. It happened passively. And the worst part is, this often happens right at the peak of a market cycle when things are most precarious.
So this is where the action comes in. To rebalance, to get back to that 50-50, you have to do something that feels very wrong.
Very wrong.
You have to sell some of those stocks that did so well, literally selling high, and then you have to buy more of the boring bonds that did nothing, buying low.
And that's the magic of it right there. It forces a kind of discipline. It makes the investor do the hardest thing in the world.
Yeah.
Sell when everyone is euphoric and buy when everyone is, bored or even scared.
So it's basically a system for risk control. It's making sure that when that inevitable market crash comes, you haven't accidentally drifted into a super high-risk position right before the drop.
Exactly. You're not trying to maximize every last dollar of gain. You're trading some of that potential upside for the certainty of risk control. You're admitting you can't predict the future.
So if that discipline is the goal, how do you implement it? How often should you be doing this?
Well, the sources lay out two main methods here.
Okay.
The first one is called calendar rebalancing. Simple. You just pick a date, say every January 1st, and you rebalance no matter what happened.
Easy to stick to, I guess.
Very easy. But it's not always the most efficient. You might rebalance when you don't need to, or you might wait months after a huge market swing.
Which brings us to the other method.
Right, which is threshold rebalancing. This is a bit more dynamic. You only act when one of your asset classes drifts by a certain amount, like say 5%.
So if your stock's hit 55% of the portfolio, that's the trigger.
That's the trigger. You sell and buy to get back to 50. The research suggests this is often a bit better for truly managing risk because it's based on actual market volatility, not just a random date on a calendar.
So the big takeaway for you, the listener, seems to be that rebalancing is a tool. It's the tool that standardizes your risk and fights that powerful urge to chase gains.
It forces you to stick to your plan, not your feelings. And that leads to a really interesting final thought for you to consider.
Go on.
Well, if rebalancing is all about forced discipline and this kind of built-in skepticism about the market, what assumptions about future market performance must you be willing to completely abandon to actually do this effectively over the long term?
That is a critical question to think about. Thank you for bringing the sources to the table for this deep dive. We hope this helps you approach your own risk with a little more discipline.
All right, so if you're even thinking about investing, there's that. That one big fear, right? The one that just stops almost everyone.
Mm-hmm. That voice in your head.
Yeah, that voice that says, what if I put all my money in today and the market crashes tomorrow?
And that feeling, that anxiety, actually has a name in our source material. They call it timing risk.
Timing risk.
Exactly. And that risk is what leads to analysis paralysis.
Yeah.
You just get so stuck waiting for the perfect moment to invest that you never do.
You end up doing nothing at all, which is a huge weight, especially for new investors.
Mm-hmm.
So what's the cure? What does this reading say is the best way to get people off the sidelines?
It's a strategy called dollar cost averaging, or DCA for short.
DCA. Okay, let's unpack that.
Well, the premise is brilliantly simple, really. Instead of making one single huge investment, a lump sum, like say $12,000.
Dropping it all in at once.
Right. You don't do that. Instead, you commit to investing a smaller fixed amount over time. Maybe $1,000 every month for a year.
And you set it and forget it.
You set it and forget it. You do it on autopilot no matter what the price is doing.
Okay, that's where it gets interesting, I bet, especially in a volatile market. Let's run the numbers from the source.
Yeah, let's do it. So month one, you put in your first $1,000 and the price per share is $50.
Okay, so that gets you 20 shares. Simple enough?
Right. But then month two, the market. It hits a major speed bump. The price gets cut in half, down to $25.
Ouch. Okay, so that's the crash everyone fears.
That's the crash. But because you're on your automatic plan, that same $1,000 still goes in. Only now it buys you 40 shares.
Wow. Okay, so double the shares for the exact same amount of money.
Exactly. Then let's say in month three, things recover a bit. The price rallies to $40.
And your $1,000 buys 25 shares.
25 shares.
Wait a second. So over those 3 months, the market's average price was, around $38?
Yeah.
But because you bought way more when the price was low, your actual cost per share is...
It's lower than that, isn't it?
It's mathematically lower. And it's not a trick. It's just consistency.
How does that work?
Because you're investing a fixed dollar amount, you are automatically programmed to buy more shares when they're cheap and fewer shares when they're expensive.
It just forces your average cost per share down.
Precisely. It protects you from accidentally going all in at the top.
That's the mechanics of it, and the math is really compelling, but I feel like that's not the whole story. Where's the real power in this?
The real power is psychological. I mean, the math is great, but the mindset shift is everything.
Okay.
Without DCA, a market crash feels like a total disaster.
Yeah.
You see your portfolio in the red, you lose sleep, you panic.
Right. It feels personal, like you made a huge mistake.
Exactly. But with DCA, your mindset it flips. A crash is no longer a catastrophe.
It's a sale. It's a sale. It's a discount. You actually start to see a downturn as an opportunity because you know your next automatic deposit is coming up and it's going to scoop up shares on the cheap.
So it takes the emotion out of it. You're not trying to be a hero and time the market.
You're just being consistent. And that's the essential nuance here. The research is clear. Mathematically, over the long term, a lump sum investment usually wins.
Simply because markets tend to go up over time.
Right. But that mathematical superiority means nothing if fear keeps you on the sidelines in the first place.
So that's the catch. Psychologically, DCA is the clear winner because it actually gets people to start. It moves you from being a spectator to an investor.
It gets you in the game. That's the whole point. The focus is on action and consistency.
Which really brings us to the final thought we want to leave you with.
Yeah, it's a question for you to really think about. If the ultimate goal for long-term success is just consistency and action,
then which strategy is truly better for you? The one that's mathematically superior but might keep you paralyzed by fear? Or the one that's psychologically supportive and guarantees you'll actually take part? Okay, let's unpack this. We're doing a deep dive into financial options, calls, and puts, and we're using those FIN 401 source notes you sent over.
right?
The mission here is to really get our heads around what these things are, but also the fundamental risk transfer that's happening.
It's all about risk.
It is. And the core idea, the simplest way to think about it, is that an option is just a coupon. Let's use the Big Mac analogy. You have a coupon that gives you the right to buy a Big Mac for $2 anytime in the next 30 days.
Right. And if the Big Mac suddenly costs $5, that coupon is great.
Exactly. But if it only costs $1, your coupon is just caper. It's worthless paper.
And here's the crucial difference from a grocery coupon, and this is key. You have to pay cash right now for that financial coupon. It's called the premium.
So the premium isn't just the price of the paper. It's the cost of buying leverage, really.
It's the cost of opportunity.
Which brings us to the first contract type,
Yeah.
the call option. This is your classic bullish bet.
Your bet that the price is going up.
It's the right to BUY 100 shares at a specific price, the strike price, by a certain date.
Okay, so let's make that real.
Yeah, let's use the Apple example. Say Apple stock is trading at $150. You buy a call option with a $160 strike price.
So you're betting it'll go above 160.
You are. And let's say Apple just soars to $200. You get to exercise your right. You buy the shares at $160.
Even though they're worth 200 on the open market.
And you can immediately sell them for a $40 per share profit.
Well, a $40 gross profit, you have to subtract what you paid for that coupon, for the premium.
Good point. So your net is a little less. But here's the beautiful part for the buyer. If Apple stays flat or it drops,
The option just expires worthless. And you only lose that initial premium you paid. Your risk is totally capped.
totally capped.
Now let's pivot to the flip side. The put option.
The insurance policy.
That's the best way to think of it. It's the right to sell 100 shares at a specific price. You pay a small premium.
And if the market crashes, someone else has to buy your shares at that guaranteed price.
Yep. So let's use the protection example. You own Tesla at $200 a share, and you're nervous.
So you buy a put option with a $180 strike price.
What does that do? It guarantees you the right to sell your shares for $180, even if some disaster happens and Tesla crashes all the way to zero.
You've essentially put a floor under your investment. You've defined your absolute minimum selling price.
Exactly.
And this right here is where the distinction between the buyers and the sellers becomes so important. It's where beginners get wiped out.
Oh, absolutely.
The person buying the option, the one paying that premium,
Mm-hmm.
we can call them the long. They are the gambler in this analogy.
Limited loss, theoretically unlimited upside.
Yes,
Mhm.
that's the dream, right? The 1,000% return that gets everyone so excited.
And then you have the person selling that option. They're called the writer or the short. They are the casino.
They collect that sweet initial premium.
They do. They collect the cash up front, and they're just hoping that gambler's ticket expires worthless. But, and this is a huge but, they are taking on uncapped downside exposure.
That's the dynamic that is so dangerous. People focus only on collecting the premium, and they forget about the obligation. If the stock makes a massive move against them,
They have to pay up. The buyer exercises the contract called assignment, and the seller is on the hook. Their risk is theoretically unlimited.
which is terrifying.
It is. And because that risk is unlimited, the system requires the casino side, the seller, to post a lot of collateral. It's called margin.
Margin.
Yeah.
So they have to prove they can cover the loss.
They have to, and that margin is constantly adjusted to make sure they have the funds to pay out if the buyer hits the jackpot.
So the whole structure is defined by this.
Mm-hmm.
This incredible imbalance. The buyer pays a small fixed price for massive potential.
And the seller gets a small fixed payment in exchange for taking on potentially infinite liability.
So when we boil it all down, what does this all mean? The price of that coupon, the premium, it's a direct reflection of that huge risk imbalance, isn't it?
It is. You are literally paying a price to hand your risk over to the casino.
So that leads to a pretty interesting final thought.
Well, if the casino side, the sellers, are required to have all this massive, constantly adjusted collateral to cover that unlimited risk, it raises a question.
Which is?
How much of the options market's daily volume is driven, not by pure speculation, but by these large institutions just trying to manage and hedge their own margin requirements against their portfolios?
Okay, let's get into it. Today we're going to unpack a real financial puzzle.
Mm-hmm.
We're diving into options pricing.
Mm-hmm.
Specifically, the two fundamental parts that make up the price you see on the screen.
And understanding this is absolutely key. I mean, here's the paradox for you, right?
Yeah.
You buy a stock, it goes nowhere for a year. You haven't lost a thing. You buy an option, it goes nowhere. You probably lose everything.
Everything. Because options are, as they say, wasting assets.
Mm-hmm.
They have this built-in death clock, an expiration date.
Exactly. So that's our mission today. We're going to pull apart those two pieces of value. You've got intrinsic value, the real hard cash value.
And then the other part, extrinsic value, which is, well, it's basically what you pay for hope.
That's a great way to put it.
So let's start with the easy one, intrinsic value.
Right.
The simplest way I think about it is asking, if I cash this in, right this second, how much money would I get?
It's just simple, immediate math. Let's say a stock is at $100, and you hold a call option with a $90 strike price. Your intrinsic value is $10. Simple. You can buy at 90, sell at 100.
That $10 is locked in. It's real.
It's real, and it can never, ever be negative.
Okay, wait. So what if the stock is at 100, but my strike price is, say, 110? It's out of the money.
Right.
I can't exercise it for a profit, so is it just worthless then?
Its intrinsic value is 0, yes. Think of it like cash in your wallet. It can be empty, but it can't be negative.
Ah, I see.
But here's the million-dollar question. If that option has 0 real value, why does the market still charge you maybe $2 to buy it?
And that's the gap, that $2.
Yeah.
That's the extrinsic value.
Exactly.
If the $10 from before was the guaranteed part, this extra $2 is what you pay for the chance the stock might go way up before it expires.
It is purely the price of two things, time and volatility. And since time is part of that price, it's also what kills it.
Which brings us to theta, time decay.
The big one.
And the rule here is just, it's brutal. That extrinsic value, that hope money, must go to 0 by expiration. And it's not a straight line down.
No, not at all. It's exponential. We call it the death clock. It's not a steady tick.
Right.
When you're like 90 days out, the decay is pretty slow. You barely notice it.
But then you cross that 30-day mark.
It starts speeding up
Yeah.
a lot. And then once you hit that final week, the value just falls off a cliff.
So if you're an option buyer, time is your worst enemy. It's just eating away at that premium you paid.
Mm-hmm.
But what about that other part you mentioned? Volatility. Why would an option suddenly get incredibly expensive, even if the stock hasn't really moved?
This is where it gets really interesting. This is Ivy Crush.
Ivy Crush.
So imagine a big event is coming up. Earnings, maybe. The market price is in maximum chaos, maximum uncertainty.
Okay.
And that volatility just explodes. That $2 extrinsic value might suddenly jump to $10. That option is now ridiculously expensive.
Because everyone's paying for that lottery ticket.
Exactly. But the second that news comes out, certainty returns. And that uncertainty premium, it vanishes. Poof.
So even if you guess right and the stock goes up, you could still lose money.
You can lose a lot of money because of that extra value, that hope premium. It collapses faster than the stock can move to make up for it. It's the ultimate lesson in market psychology.
So what this all really means for you is that every single option price is just a combination of real value and hope value, 4V and EV.
And that hope value, the EV, is always in a losing fight against the clock.
Right. So here's a final thought to chew on. If we know that time decay gets exponentially faster in the last 7 days, I mean, what kind of strategies could you even develop that use that extreme risk and the potential for huge returns that's all packed into the final frantic week of an option's life?
It really makes you rethink your entire approach to time, doesn't it? Something to consider.
All right, welcome to the deep dive. So you sent over this material about options trading and specifically what our sources call the Greeks.
That's right. And they're not just, abstract terms. They're presented as a kind of critical dashboard.
A dashboard for a trader, like in an airplane cockpit.
Exactly. Think of it like an altimeter, a speedometer, and maybe a fear gauge, all in one. We're talking delta, theta, and vega. They tell you exactly how an options price is going to react.
Okay, let's unpack that. Let's start with the one that sounds like it's about movement. Delta.
Delta. So delta is how much an options price changes for every $1 move in the actual stock. It's on a scale from 0 to 1.0.
So if I have an option with a delta of, say, 0.50.
And the stock goes up $1, your options price goes up 50 cents.
Okay, simple enough. But if I want that dollar for dollar movement, why not just buy the stock? What's the hidden value here?
This is the really cool part. The secret use of delta. It's basically a quick and dirty way to see probability.
Probability?
Yeah. An option way out there with a delta of 0.10. You can look at that and think, okay, there's roughly a 10% chance this thing will actually finish profitably. It's a long shot.
I see. So it's not just a price metric, it's a risk assessment tool. Instantly tells you if you're holding a ticket for a likely winner or something else.
Precisely. So delta covers where you're going. But what about the cost of just standing still? That's where we get to the silent killer. Theta. It's the amount of value your option loses every single day just from time passing.
Yeah.
For a buyer, it's always, always negative.
And the sources frame this as rent, right? The daily rent you pay to hold the position.
It's the perfect analogy. You see a theta of nanid 0.05. That means your position is bleeding $5 per contract every
Right.
single day.
And that's a constant bleed. Where does it get worse?
Oh, it gets much worse. That's the trap. It's not linear at all. The decay accelerates like crazy as you get closer to the option's expiration date.
So you might lose a little in the first month, but a ton in the last week.
You could lose 50% in that final week. You have to be right, and you have to be right quickly, or theta will just eat your position alive.
Wow. Okay. So we have direction with delta and the cost of time with theta. That brings us to the last dial on the dashboard. Vega.
Vega. This one measures the option's sensitivity to volatility, to, fear.
Fear.
Yeah. I mean, what's so fascinating is that the stock price could stay completely flat, but if the market gets nervous, if volatility spikes, the price of your option goes up.
So Vega is like an anticipation gauge. It measures expected turbulence.
It does. And that means right before some big event, like a company's earnings report, options get really expensive. The sources call it crisis pricing.
Because everyone expects a big move, even if they don't know which way.
Exactly. And that's why you almost never want to buy options when Vega is super high. You're paying a huge premium for that uncertainty. The entry price is just punishing.
Okay, so let's pull this together then. Delta is direction. Theta is the tax of time. And Vega is panic.
Perfect. And to really lock it in, our sources gave us that brilliant taxi ride analogy.
Right. So delta is the distance you travel in the taxi.
Yeah.
It's how far you're moving toward your destination.
Mm-hmm. And theta is the meter that's running even when you're stuck in traffic. You're paying rent just for sitting there going nowhere.
In Vega.
Vega is the surge pricing. It suddenly starts raining and everyone wants a cab at once.
Right.
The trip itself hasn't changed, but the price to get in just shot through the roof because of the panic.
That really clarifies it. So mastering this dashboard is everything. But it leaves me with a final thought for you, the listener, to chew on.
Mm-hmm.
If Vega is the fear gauge,
Mm-hmm.
how do you, as an investor, distinguish between legitimate, necessary hedging against real risk and just simple, expensive panic that's driven by high volatility?
Yeah.
Something to think about.
Welcome to the Deep Dive. Today we're getting into a topic that most people tend to overlook, futures contracts.
Mm-hmm.
It's this huge global market that really sets the price for, well, almost everything, your coffee, the gas in your car. But the crazy thing, the paradox here, is that this market wasn't created to raise capital like the stock market.
Not at all.
It was created so people wouldn't starve.
And that origin story is everything. It tells you the original function was all about managing risk.
Yeah.
So our mission today is to really break that down, to unpack the ironclad legal obligation that defines futures and the incredible leverage that makes them so powerful and so dangerous.
Okay, so let's start with the classic analogy. You always hear about the farmer and the baker, right?
Right, the foundational story.
It's March. A farmer is planting wheat, and he's terrified that by harvest time in September, a huge supply glut will crash the price.
Meanwhile, you've got the baker who needs that wheat in September, and she's just as terrified that a drought will make the price skyrocket.
So they have opposite fears.
Exactly, so they shake on a deal.
Hmm.
Right now, in March, they agree to trade, say, 5,000 bushels in September at a fixed price. Let's call it $5 a bushel.
Okay.
That simple agreement completely eliminates the price risk for both of them. The farmer knows his revenue, the baker knows her cost.
Mm-hmm.
That's it. That's the reason this entire market was born.
What holds them to that deal? I mean, if the price of wheat shoots to $10, what stops the farmer from just walking away?
And that brings us to the core concept here.
Obligation.
Yes. It's not like an option where you have the right to buy or sell.
Right.
With the future, you must fulfill the contract.
That must fulfill is the legal anchor. It explains everything. Oh, it's true. Something like 99% of the people trading today are speculators. They have no intention of ever seeing a barrel of oil.
Right. They're just betting on the price.
Exactly. They get around that physical delivery by just closing out their position before the contract expires. But they're drawn to the market for one reason.
Unmatched leverage. To control, say, $100,000 of Apple stock, you might need to put up $50,000 in cash. That's 2-to-1 leverage.
Standards.
Very standard. But in futures, to control $100,000 worth of crude oil, the exchange might only require $5,000 in your account.
Wait, 5,000? That's what, 20-to-1 leverage?
20-to-1. And that is why it's so explosive. Because with that kind of leverage, if the price of oil just drops by 5%, which can happen in an afternoon,
A routine Tuesday.
a routine Tuesday, that 5% drop wipes out 100% of your cash. Your account's gone instantly.
And that idea of a non-negotiable physical obligation, It feels so abstract until you look at the ultimate real-world catastrophe, April 2020,
Oh, yeah.
when the price of crude oil didn't just crash, it went negative. It settled at minus $37. How was that even possible? How can a physical thing cost less than zero?
That was the moment where the abstract suddenly became brutally real for the speculators.
But-
They had failed to sell their contracts before they expired.
So the clock ran out.
The clock ran out. And they were now legally obligated to take physical delivery of millions of barrels of oil. But there was nowhere to put it. All the storage tanks in the world were full.
They literally had no place to store the oil they were forced to buy.
So that minus $37 price, that wasn't the value of the oil. That was the fee they had to pay someone, anyone, to please take the oil off their hands so they wouldn't default on the contract.
Wow. So the very rule designed to help the farmer is what completely destroyed the speculators. So what's the takeaway here for you? Futures are this vital tool for managing risk for the world's producers and consumers. But they have this extreme inherent leverage and this very real threat of physical obligation.
And it leaves you with this kind of nagging question, doesn't it? If 99% of the trading in this market is just pure speculation.
Just financial betting.
Yeah. What does that massive concentration of money do to the original crucial function of the market? For the actual farmer and the baker. Does all that speculation actually make it harder for them to discover a fair price or easier? That's the real tension at the heart of it all.
Welcome back to the Deep Dive. Today we're exploring one of the most counterintuitive ideas in all of finance.
Right.
Making a trade where you actually intend to lose money on it. At least if everything goes well.
It sounds strange, but it's really just paying for peace of mind. You're buying an insurance policy, and you hope you never, ever have to use it.
So our mission for this deep dive is to look at two big strategies for this and, really analyze the true cost of that insurance.
Okay, let's unpack this.
Let's jump right in with a scenario for an individual. Say you have $1 million portfolio, you're worried, maybe you see a crash coming.
But you can't sell.
Nah.
Maybe the tax implications would be huge.
Exactly. So you're kind of frozen, just sitting there, completely exposed to whatever the market does.
And this is where the solution comes in. It's called a protective put.
Her protective put.
Yeah, you buy something called put options on an index, like the S&P 500.
Yeah.
And a put option just gives you the right to sell at a set price later on.
So what does that actually do?
It immediately creates a concrete floor under your portfolio. Your losses are capped.
But that floor, that insurance, it's not free. It has a premium, right?
It does.
So say you spend, I don't know, $20,000 on that protection. What does the math actually look like?
Well, this is where it gets brilliant. Let's take two scenarios. Scenario A, the market rallies. It goes up 10%.
Okay, so my portfolio just made $100,000.
It did. And that $20,000 you spent on the puts, it expires worthless. You lost it.
So a net profit of $80,000. I can live with that.
You can definitely live with that. But now, scenario B. The real reason you bought the hedge?
The crash.
The market crashes hard.
Yeah.
Your portfolio loses $200,000. A disaster. But those puts you own, they explode in value. They might gain you $180,000.
Right, so the net loss is only $20,000.
Exactly. The cost of the premium. You paid $20,000 to completely avoid a $200,000 catastrophe. You lost far less, and you definitely slept well at night.
Okay, so shifting from an individual's anxiety to a huge corporate risk, let's talk about airlines.
Their biggest, most volatile cost is always jet fuel. If oil prices suddenly double, they could face bankruptcy. It's an existential threat.
So how do they hedge that?
They use something similar, often oil futures contracts. This just means they're locking in the price they'll pay for fuel, sometimes years in advance.
So if crude oil goes through the roof, they're losing money at the pump, but
they're making equal amount of money on their futures contracts. It completely offsets the extra cost.
And this is where it gets really interesting, right? The Southwest Airlines example from 2008.
Oh, that's the textbook case study.
Yeah.
In 2008, oil hit these historic highs. Almost every other major airline was just drowning in red ink.
But not Southwest.
Southwest was the only profitable one because they had been systematically, aggressively hedging for years before that. They'd locked in cheap oil prices 5 or 6 years before the spike even happened.
That is just undeniable financial security. But you mentioned there's a serious cost that gets overlooked. You called it the drag.
Yes, the drag. Think of it like a constant slow leak in your performance.
So those premiums, that $20,000 on the puts or the fees for the futures, that's the drag.
Precisely. They are constant costs that just chip away at your returns year after year, even when nothing bad happens.
Yeah.
If you're a disciplined, constant hedger, you are constantly paying this tax.
So what does that add up to?
Well, our sources show that if you maintain a continuous hedge on your portfolio, you are almost guaranteed to underperform the market by about 2, maybe 3% every single year.
So what does this all mean then?
It's a trade-off.
It seems like what we've seen is that hedging basically exchanges potential upside for guaranteed certainty. It puts that floor in for investors, and it shields these massive corporations from disaster.
And that really is the ultimate question for you, the listener. You know the cost now. It's that guaranteed 2 to 3% of annual underperformance. Is the peace of mind worth it? Is the ability to sleep well at night worth accepting that certain guaranteed lower return? So here's a fascinating question. How do you actually put a number on something as abstract as, market panic?
It's a huge puzzle. But back in 1993, the CBOE, the Chicago Board Options Exchange, they actually tried to solve it.
And that's what created the VIX, right? The volatility index, everyone calls the fear gauge.
Exactly. And that's our mission for this deep dive. First, to really unpack how it works, which is surprisingly intuitive.
Okay.
But second, and this is really critical, we need to understand why the products you use to trade it have this major mathematical trap built right into them.
Okay, let's jump right on that. The VIX isn't based on stock prices.
No.
It's based on option prices.
Eee.
How does that even work? How does the price of a hedge measure how terrified the market is?
Well, the best way to think about it is insurance. It's all about insurance.
Insurance?
Yeah, specifically contracts called puts. They're what investors buy to protect themselves if the market suddenly crashes. So in a calm market, when everyone's feeling complacent, nobody's really buying much protection. Demand's low, so the insurance is cheap.
And a low price for insurance means the VIX is low.
That's it. We're talking below 15. That's the boring zone.
But hold on a second. If it's just measuring the price of this insurance, is it really measuring fear? Or is it just measuring wealthy investors buying protection? Is it skewed?
That's a great question. It's really measuring the cost of that fear. And that cost is, let's say, highly correlated with actual panic.
I see.
Because when real anxiety hits, investors don't just walk, they sprint to buy those puts.
And that demand spike sends the price of options through the roof.
Exactly. And that explosion in price is what sends the VIX soaring past 40. The index is tracking exactly how desperate people are for that insurance policy.
So we can actually use these as benchmarks. I mean, if I'm looking at our source material, a VIX below 15 is deep complacency.
Right.
And maybe 20 to 30, that's what, some nervousness?
Yeah.
A normal correction.
Yeah. The normal correction, yeah, exactly. But once you cross 40, you are in full-blown panic territory.
Like 2008.
Like 2008, or when the COVID lockdowns really hit the market in 2020, those are the moments that gave us that classic market rule.
When the VIX is high, it's time to buy. When the VIX is low, look out below.
You got it.
It always sounds a bit like a pirate shanty, doesn't it? But okay, here's the key. How do you actually trade this? And what's the big trap you mentioned?
This is where it gets really, really interesting. You can't just buy the VIX. It's an index.
Right.
You have to use products like an ETF called VXX, and this is where we have to issue the critical warning about the contango trap.
The contango trap. Okay, that sounds like serious jargon. Break that down. Why is it so dangerous if you just, hold on to it?
Well, the thing is, these funds, they don't actually hold the VIX. They hold VIX futures contracts. And because future volatility is almost always priced higher than today's volatility, that's contango, the fund is constantly selling the cheaper near-term contract to buy the more expensive longer-term one.
It's mathematically designed to lose money over time.
It is designed to bleed value. I mean, they're only for very short-term trades. A day, maybe a week. If you hold something like VXX for a whole year, a 90% loss is pretty standard.
90%. Wow. And this isn't just a theory, right? There was Volmageddon.
Oh, yeah. Volmageddon in 2018 is the perfect, terrifying example.
What happened there?
There was this fund, off 14. It was designed to do the opposite of the VIX, so you were betting on calmness.
A bet on things staying boring.
Exactly. And then one afternoon, the VIX had a massive spike. And that Axe Foyt fund, it went to zero. Wiped out.
How fast?
In about 45 minutes. Billions of dollars just gone. A terrifying lesson in what happens when you hold these decaying products.
So to tie this all together.
Look, the VIX is a brilliant tool. It's powerful. It's insightful. It measures real fear by looking at the price of insurance.
Right.
But the products you have to use to trade it have this this built-in risk, this mathematical decay that makes them incredibly toxic for the average long-term investor.
So what does this all mean for you? If the VIX is really a measure of market anxiety, based on what people will pay for protection, here's a thought to mull over. What non-financial indicator, maybe Google search trends or even social media sentiment, what do you think tracks its movements the closest?
Welcome to the deep dive. Today we're getting into a concept our sources call a few different things. The double-edged sword, for one.
And the speed multiplier. Both are perfect descriptions, really.
They really are. We're talking about leverage. And at its heart, it's pretty simple, isn't it? It's just borrowing money to try and amplify your results.
Exactly. But that amplification, that's where things get interesting and dangerous.
So let's set the stage. The classic example is always real estate, right? It's intuitive.
It is. So let's say you buy a house, $500,000, and you pay all cash.
Okay, no loan.
No loan. The market has a good year. The house value goes up 10%. You've made 10% on your money. Simple.
$50,000 profit on a $500,000 investment. Makes sense.
But now let's use leverage. Same house, but you only put down $50,000. So that's a, 10-to-1 leverage?
Right. You borrow the other $450,000.
Exactly. Now, the asset, the house still goes up by that same 10%. That's still a $50,000 gain in value.
But you only put in $50,000, so you've doubled your money.
You've made a 100% return. That's the speed multiplier.
But here comes the other edge of that sword.
Here it comes. Because if that $500,000 asset drops by 10%,
your $50,000 is just gone, wiped out completely.
100% of your equity vanished. And in the stock market, this all happens much, much faster.
Right, because you're not dealing with houses, you're dealing with a margin loan from a broker.
And the key concept there is the maintenance margin. The broker says, look, a certain percentage of the account's value has to be your own money. Usually it's around 25%.
And that's not a friendly suggestion. This is the broker's safety net, not yours. If you fall below that line...
They don't call you. They don't ask nicely. An algorithm just sells your stuff. It liquidates your positions instantly to get their money back.
Which can create this horrifying cascade effect, the death spiral.
That's it. Because a breaker having to dump millions of dollars of a stock forces the price down.
Which then triggers someone else's margin call.
And then they are forced to sell, which pushes the price down even more. It feeds on itself.
It's a chain reaction. Okay, so with a normal margin loan, you can only lose what you put in. But there's a way to lose, everything. And more.
Infinite losses.
Short selling.
Yeah. With short selling, you're borrowing shares to sell them, betting the price will go down so you can buy them back cheaper.
But if you're wrong, if the price goes up...
There's no limit to how high a stock price can go, which means there is no limit to your potential loss. You still have to buy those shares back eventually.
And we all saw this play out with GameStop, GME.
The perfect example. Hedge funds had massive short positions. They were betting it would go down.
But a huge number of retail investors started buying, pushing the price up from $4 to...
It went to over $400 at its peak. So the hedge funds got margin call, but to close their short position, they had to buy the stock.
So their forced buying just threw gasoline on the fire?
It created a massive feedback loop. Their buying pushed the price higher, which triggered more margin calls, which forced more buying. Billions and billions of dollars in losses.
It's brutal.
Yeah.
Which I think connects to the psychology of all this. You found that great story about Archie Carrot?
Oh, yeah. The ultimate example. He leveraged $50 into $40 million playing craps and poker. An unbelievable run.
$40 million.
But he never took his foot off the gas. He kept the same extreme risk level, and he lost all $40 million in 3 weeks.
So what's the takeaway here for you listening? It seems like leverage is this incredible tool for winning fast.
It is. But the cost is that you completely remove your ability to survive bad luck. Or even just one bad decision. You can be right 9 times out of 10, but that one time can be extinction.
So it's not just a financial tool. It's a force you have to respect.
Absolutely. And that raises the final question, I think. When you use leverage, you have to understand the fundamental shift in the game you're playing. You're no longer just playing to win. You're playing not to lose everything on a single roll of the dice. And that's the difference between amplification and, extinction. Welcome to the Deep Dive. Today, we're tearing into Nassim Taleb's The Black Swan. It's a book that really just fundamentally changes how you see risk, data, and, most predictions are probably worthless.
That's exactly right. Our mission today is a focused one. We want to understand why traditional systems, especially in finance, fail so catastrophically.
Because they just can't account for that one rare event.
Precisely. And then we'll get into what Taleb suggests we can do about it, how to build systems that might actually thrive when chaos hits.
Okay, let's just get right into it with the single most famous idea in the book, the turkey problem. So imagine a turkey. For 1,000 straight days, a farmer feeds it, cares for it. Every single data point the turkey gathers confirms the farmer is its best friend.
The evidence is overwhelming. Based on that data, the turkey's risk model says the probability of anything bad happening is, statistically zero.
It is a mountain of proof. And then comes day 1001. Exactly. That single event, the black swan, it's completely unpredictable from the turkey's point of view, and it invalidates all the previous data instantly.
And this is the fatal mistakes that so many financial models make. I mean, traditional finance is built on the normal distribution, the bell curve.
Right, the thing we all learned in stats class.
Yeah, and that model assumes extreme events, like a massive market crash, are so rare they should only happen, like, once every billion years.
But that's not what we see in reality. Not at all. The real world, especially financial markets, has what Taleb calls fat tails.
Meaning those extreme events are way, way more likely than the bell curve suggests.
I mean, just look at the last few decades. We've had 1987, the dot-com bust, in 2000, 2008, 2020. These aren't once-in-a-billion-year events.
It's like building a bridge assuming the wind will never exceed 50 miles per hour because that's the average.
Yeah, but, a 100-mile-per-hour hurricane hits the coast every 10 years.
Exactly. Your model feels safe, but reality has a hurricane waiting in the wings.
And this flawed math, it leads directly to these risk management tools banks use, like value at risk or VAR.
Oh, VAR, at the ultimate false comfort.
They give you this very reassuring statement, something like, we are 99% confident we won't lose more than $10 million tomorrow.
And the killer flaw is right there in what they're not saying. It's all about that 1% they brush aside.
Because in that 1% scenario, it's not that they lose 11 million.
No, they lose 10 billion. It's a complete wipeout. VAR is great at measuring the small, everyday bumps, but it is completely blind to the one event that destroys the entire bank.
So if prediction is useless and our tools are blind, what do? Just hide in a bunker with gold bars?
Not at all. This is where Taleb's big idea comes in. You have to stop trying to be robust, which just means you can take a punch. You need to be anti-fragile.
Anti-fragile? Meaning what, exactly?
Meaning you actually get stronger from stress and chaos. Think of human muscles. Without stress, without lifting weights, they get weaker. They need that volatility.
Okay, so there are three states. You have fragile, which hates chaos.
Like a bank loaded with debt.
Then robust, which just resists it.
Think of gold or cash. It survives, but it doesn't gain.
And then anti-fragile, which actually loves the disorder. It feeds on it.
And that brings us to the most practical takeaway for you, the barbell strategy.
Right. And this is where it gets really counterintuitive.
It does. The strategy says you should actively avoid the middle, all those moderately risky diversified funds.
Wait, avoid diversification. That's the opposite of what everyone is taught.
I know. But in a world with fat tails, that middle ground gives you mediocre returns while still leaving you completely exposed to that black swan event that wipes you out.
So the barbell is,
yeah,
you go to the extremes instead.
Exactly. You put, say, 90% of your assets in something incredibly safe. Treasury bonds, cash, something that cannot be destroyed. That's one end of the barbell.
The robust end.
The robust end. And then you take the other 10% and put it into extremely risky, high-reward bets. Venture capital, speculative options, things that benefit from massive volatility.
So you're protected from ruin by the 90%, but you have huge upside potential from the 10% if chaos hits.
That's the idea. The goal isn't to predict the future. It's impossible. The goal is to set yourself up so that when the unpredictable crash happens, it doesn't kill you. It might even help you.
You're not trying to see the black swan coming. You're just making sure it can't eat you when it lands.
Which leaves a pretty big question for you to think about. If this is how unreliable our data is for finance, what other parts of your life are you basing on 1,000 days of good weather, your career, your projects? Where is your Thanksgiving Day event just waiting to happen?